Chinese debt concerns that we spoke about in the past few days, the China rate hike today, and of course further indications about trouble out of the Eurozone as well. Larry Shover is from Efficient Capital Management, joining us from Chicago for the show. Larry, I guess one thing about the rate hike is it puts the focus back on inflation because China is fighting inflation. How did you see that focus affect some of the markets you were watching today, or some of the price action?
You know, today the markets basically shrugged it off. I think everybody's waiting for next week's CPI number in China. The market consensus seems to be like 6.25% compared to 5.5%. The way the commodities were trading today, shrugging off most of the dollar's gains, was telling me that the 25 basis point rise in China's rate didn't really matter a whole lot, and everybody's looking towards the CPI number next week. It
did affect the copper price, though, didn't it? We saw that some of the base metal prices actually coming off. Does that change your view that the worst of the bear phase for copper is over, which you've kind of declared as of the last week?
Yes, and yes, I think the worst of the phase is over. I don't think we're going to be in a wild bull market in copper by any stretch of the imagination. But conservative estimates is that global use of refined copper is about 5% a year. And right now, mining output is about 3.5%. I just read something last night that Australia is actually looking for workers to mine this stuff. So it's hard for me to believe that copper won't rally from this point forward, given something else that's very important, is that the premiums in Shanghai continue to rise, even from last week, from $120 to $150 per ton. That means something. That means people are realizing that, hey, we're turning buyers here. The worst is over in China. Let's get copper going again.
Larry, good morning. It's Martin Lakos here. Look, we've been of the same view. In fact, Macquarie raised its long-term forecast for the copper price to $5.25 a pound, and we're certainly seeing, with those premiums going up in Shanghai, that it would appear that inventories are relatively low compared to this time last year. Would you agree with that?
I would certainly agree with that, and I like Macquarie's prediction of $5.25 a pound. I can see that happening in the next 6 to 9 months easily. It's just amazing that just 2 or 3 things all seem to happen in the copper market over the last week, where it's been in such a tight range, and all of a sudden, Greece situation seemed to be better last week a little bit, turned all the funds to be buyers. Also, as I just noticed, the premiums continue to rise. I mean, at one point, the forwards were trading at a discount. I mean, it's crazy. I can't see copper going anywhere but up from this point forward.
You talked of the change in sentiment, and you said that was basically, in your notes here, that was once the Greek debt crisis was temporarily solved. Doesn't that mean that that issue can come back and become a negative issue, although it might be positive right now?
Yeah, absolutely. Maybe I was grabbing at straws and sending a prayer, hoping that the Greece situation will be resolved in a good way. But no, if we have a selective default, which seems like that's going to happen, it may affect a little bit. It's not going to affect the global economy as badly as most of us think. I mean, think about the spread between the 5% of global use of copper on any given year, and that's a conservative estimate. And there's no scrap to be had, and mines are only putting out 3.5%. Nothing else is going to stay here, but I do believe we're going to rally long term, 6 to 9 months.
Larry, can I just ask on a different tack? You know, we're now hearing more and more about the debt ceiling issue and the conflict between the two political parties in the US. How serious is this? It would appear that the markets, for the moment, are not paying attention to it or are prepared to ignore it. But is this something that could bite us in the next couple of weeks?
Martin, that's a very good observation. I think the market's pricing in the fact that right now we're having your classic banter back and forth, threatening. Obama came out again saying that raising taxes has to be part of this Deficit Reduction Act. Republicans say no. At the end of the day, we all have too much to lose by not letting this pass. And by July 22nd, something has to be passed. And I firmly believe, as the market does, that something will be passed. It'll make nobody happy. It might just be a mini deal. But think of it this way. Right now, our debt to GDP is 92%. Put it in perspective. In your country, it's only 22%. We have a serious problem on our hands, and it's got to get straightened out right away. And we have too much to lose by not letting it get straightened out.
Yep.
So you certainly think that they, given those numbers, they can't afford to let this get blown out of perspective, and will have to step back away from their political side to make sure that actually it gets passed.
Absolutely. It's pretty straightforward what needs to happen. I mean, we just need to stop spending. I mean, we don't have a revenue problem. We have a spending problem, like most governments, and some hard choices will have to be made. But given the general laziness of the markets right now, it appears to me that something will get figured out sooner than later, no matter how much banter there happens to be.
Can I just also ask, I noticed some commentary this morning off Bloomberg that the transportation index on the Dow is about 20 stocks in that, and that's often viewed as a bit of a proxy for economic growth. That hasn't been talked about for a while, but that's been quietly going up. Is that something the markets are now talking about in the US?
You know, a lot of people are talking about it like, hey, our stock market in general is severely undervalued. But you both know that stock markets can stay undervalued and overvalued for a long time. And one thing that's really hard to predict, no matter how much you write about or research about it, is consumer spending. And it seems like the individual American has gotten their house in order, and the next thing that's going to occur is consumer spending, and that's what we're leaning on. That's going to probably come out before our job situations gets better. That said, it seems like people will start buying automobiles again, bring up the manufacturing and the transportation index. So yes, it's very quietly starting to occur.
Why would consumers start to spend now? We've kind of got a similar debate going on here. We've got an 11.5% savings rate. And yet our retail, because of that, our retailers are struggling. We're just wondering when people start to spend again and what will spark that. What do you think sparks spending, some decent spending in the US economy?
I think I would get the Nobel Prize if I had that answer.
Yeah.
And that's something that's so perplexing. There's so many different models on consumer spending. That's one variable no one seems to be able to figure out. But keep in mind, Americans love to spend money. They don't like to save money, and they can only go so long without having a new car. People have delevered properly in the last couple of years. That deleveraging has gotten them to the point where, hey, maybe it's okay to step out and buy that car right now. I'd like to see that happen in the next 6 months. I mean, I do believe a year from now we'll look back and see that one component just come out of nowhere and help our economy and the stock market rally to new heights.
Fascinating as always, Larry. Thank you very much from Efficient Capital Management in Chicago.